Hello, everyone. Today is August 18th, 2025. It is almost 5 o'clock. I'm headed to Jiu-Jitsu here in a little bit. I'm wearing my New Haven pizza shirt, loud and proud. I received no compensation, just good pizza, okay? I bought this t-shirt, I buy all the pizzas. Go see my brother Blaine in New Haven. He makes some phenomenal pies. He's been slinging pies for over 40 years. Now, with that being said, my name is Luke Fenwick. I am an investment advisor representative for the firm that I started, Fenwick Financial. None of what I'm about to say is investment advice to you. I have no clue what your objectives are, what your finances are. This is just for informational purposes only, okay? With that being said, I really want to talk about the bond market. The thesis of this video is a new way I might utilize cash in my account. So instead of keeping cash just sitting there idle in my account, I have found a very interesting ETF that I'm going to try out. This ETF is the Roundhill Weekly T-bill ETF. The ticker symbol is WEEK. Week, a very clever and catchy name for the purpose of what they're trying to achieve, which is weekly income off of treasury bills. Now, that's a lot of information. I'm going to break it down to you. Our government issues debt, and people can buy that debt. So you know how you might go to a bank to borrow money for a home? Well, the government will borrow money to finance roads, to finance construction projects, to finance all sorts of government spending, okay? And they pay a yield for this. It is a fixed coupon rate. And for T-bills, the payment is made only once, and that is at maturity. So the government, you can lend them $10,000, and you only pay, this is just example, you only pay $9,800. After 3 months, they're going to pay you back $10,000. So your money made you $200, okay? That's just an example of a fixed coupon. Now, after these bonds are issued, they can be traded on the secondary market, but the prices fluctuate based off of economic outlooks. So I'm reading off my notes here to try to add a couple things. Let's see here what I really want to highlight. This again is a weekly distribution paying ETF, and they invest in treasury bills. Treasury bills are just government debt issued from zero to a year out. It's short-term debt, okay? And this ETF invests in 0 to 3 month ETFs. They use a ladder structure where they buy T-bills every week, and then those T-bills also mature every week. So they're getting a payment, and they distribute the income back to shareholders, and they roll over the initial investment. Okay, so they're trying to keep the net asset value and the price per share at $100. And right now, these short-term T-bills, you can see this through Thinkorswim. They're paying almost a 4.1% yield annually, paid out weekly. So you're getting about 7 cents a week in payments. That's really interesting. Okay. Now, I want to talk about bond prices and how these yields change. It's very similar to the stock market. Okay. So when prices go up, the yield will go down. When prices go down, the yield goes up. The return you receive goes up because you paid less for it. Does that make sense? So these bond yields will fluctuate rapidly based off of prices. Now, what I'm noticing is that the stock market SPY is what I use to look at the S&P 500, is at all-time highs. It kind of seems to be rolling over, and at the same time, bond prices are going down. And since bond prices are going down, the yield is going up. Now, this is a BlackRock issued ETF. It is 20-year Treasury bonds, and it's paying 4.61%. Now, as this price goes down and travels down further and further, that 4.61% will go up. And investors like me think, well, if I can earn 5% on my money, and I forgot to say that government debt is taught in school to be the most, I'm not supposed to say the word guaranteed, but in the finance books in school, they say guaranteed, that government debt, the United States government will guarantee your money. Now, the government could default. That could happen, and that is all over the news right now as we pass $37 trillion in debt. So keep that in mind. It is definitely not guaranteed return, but as bond prices go down, the yield goes up. So people think, and this is how stock prices kind of work, is that if this gets down here in 5%, that's going to put pressure on the stock market. Investors will think, well, if I can earn 5% guaranteed, not really guaranteed, but if I can earn 5%, I would rather do that than take the risk of investing in stocks at all-time highs. So I do kind of think that the stock market might face some selling pressure here coming up. All right. Now let's get back to week. I don't like TLT because, as you can see, the price fluctuates really, really rapidly. I'm trying to find a cash alternative for my account, something that will keep my investment value the same but pay me more than just cash sitting in my account. And this is a very, very interesting alternative to me. Week is the very first U.S. Treasury ETF to pay weekly income. Most bond and T-bill ETFs pay monthly to quarterly. Now, TLT, we can see it here under the trade tab that it pays monthly. Okay. But this week pays quarterly, and it's in a lot more short-term debt, 0 to 3 months. Typically, the value for 0 to 3 month bills don't change that month because their expiration is coming up so soon. Okay, so how does we keep its price around $100? They use, again, short-dated T-bills. Weekly invest in 0 to 3 month Treasury bills, which have very little price volatility. They have a stable net asset value objective. Week's goal is not to track an index like the S&P 500 or the technology sector, but to maintain the price at or around $100. Now, minor fluctuations do happen based on distributions. If you know anything about stocks, when they distribute income, the price of the stock will fall by the distribution. So every week you can pretty much see the stock going up to $100.08, and then it'll drop back down to $100. Okay. This is an actively managed fund. The fund manager actively rolls T-bills and invests cash efficiently, trying to smooth out any price swings. So T-bills don't send coupons. What happens is they're sold at a discount and they pay full value at maturity. So again, you might buy $10,000 worth of T-bills. That's what their value is at maturity, but you pay $9,800 now. You gain $200 later. That is the yield. Let's see what else I wanted to talk about. Let's see. Now, what I really like about this ETF is that any brokerage account can own it. Roth IRAs, traditional IRAs, individual accounts. I don't personally have a Treasury Direct account. That is how you directly buy government debt. I find this to be a really interesting way. It's super accessible. It's connected already to my account. So I think my plan is going to be this. I'm going to, as stock market hit all-time highs or any cash I have sitting idle in my account, I will probably put it in this ETF. And then when stock prices get to where I want them to be, when I think they're at a discount, I'll sell weak and move that money into stocks. Now, you will pay higher taxes on this than money sitting in a bank account. But you're getting a higher yield. So it kind of pays the taxes for itself. At least that's how I like to think of it. Let's see. Now, this does have an expense ratio for the active management. I believe it's 0.19%. So if you invest $10,000, $19 a year will be sent to the investment company Round Hill. Again, the taxes are ordinary income. Now let's pull up Round Hill's website just to go through their information directly for you. Again, this is just a really interesting way to earn some income on the money sitting idle in my account without taking massive risk. That's my purpose here, because again, stocks are at all-time highs. I don't want to just be blindly buying into it. I kind of want to try to wait for a discount using Gerald Peters' money flow strategy. I've talked about that a lot. Look back on my Substacks to understand what I'm talking about the money flow, about how price moves in three stages, either up, down, or sideways. And right now, we've gone up and up and up, and now we're going sideways. And I just don't want to take the risk at buying at all-time highs. So here is Round Hill's website. You can find this through Google, just typing in Round Hill Investments. Again, this is a short-term Treasury bill ETF designed to pay weekly distributions of current income to shareholders. It's the first of its kind, and it targets a stable net asset value week over week. It's an actively managed ETF. This distribution rate is based off of a year, and they pay out weekly. Weekly distributions, like I said, cash-like alternative, stable net asset value. Now, here are their holdings, and as you can see, they own United States Treasury bills with expirations, with maturities every week. Every Tuesday is what it looks like. So here they got investments there, and they just keep rolling this over into T-bills. Now, the performance should stay relatively flat, but they're paying out weekly income. Here is their distribution calendar. So the declaration for this is what's coming up. This is next week, will be the 25th, which you have to own it by the ex-dividend date, which is the 26th. And then the record date when the money gets paid out is the 27th. So Wednesday. It looks like it pays out every Wednesday. You have to own it before Wednesday to get that week's payment. And the distribution seems to be relatively the same throughout, 0.078 cents. It fluctuates a little bit, and that is totally okay. And as the Federal Reserve messes with the interest rate, this rate could change. So if you have a high yield savings account, I'm sure this is pretty much what they're doing in the high yield savings account. It will go down. Some pay at the beginning of the year. One of mine paid like 4.5%. Now it's at 3.7%. So as the Federal Reserve drops rate, this distribution rate may drop as well. Let's see if there's anything on here I can help you all walk through. I like to look at the fact sheet. We'll pull that up and see if there's any really interesting information on that for you. It kind of just says the same thing, and then it has some risks over here, such as such conditions may not continue to exist, and there should be no expectation that this performance may be repeated in the future. We are investing in U.S. government securities. These are subject to interest rate risk, but generally do not involve the credit risk associated with investments in other types of debt securities. As such, securities are backed by the full faith and credit of the U.S. government. That is exactly what every bill says, the full faith and credit of the U.S. government. As a result, the yields available from U.S. government securities are generally lower than the yields available from other debt securities. U.S. government securities are guaranteed, only as to the timely payment of interest and the payment of principal when held to maturity. Here are the other risks associated with this. Let me know if you have any questions. I'll try to answer them the best I can. I have got to get to jujitsu today and get my head pounded into the floor. So yeah, I really appreciate you all tuning in. I hope that this helps someone. Hope that this helps teach someone how to make a little bit of money with their money. You don't have to work so hard. You don't have to get things right. You just got to get things going. Okay. Now, a little disclaimer again, this is not personal investment advice. I'm not telling you to buy this. I'm just trying to give you information. No SEC or state authority approves or disapproves this message. Any links I talked about or any tickers I talked about, I'm not at risk for that. If you watch this video, you understand that. Thank you so much for tuning in. Peace out. Have a great, great Monday, baby.